Welcome. This is the Lifetime Cash Flow Through Real Estate Investing podcast. This is where you'll learn strategies to help you achieve lifetime financial freedom through real estate investment. Your host, Rod Khleif, has owned over 2,000 homes and apartments, and he brings experts in all aspects of real estate investment and management onto the show. Now, here's your host, Rod Khleif.
So I have a couple of housekeeping things for you guys. I've been waiting to get some testimonials from my book, so I still haven't put it on Amazon. Now, if you haven't gotten your free copy, make sure you do. It's 200 pages. It's total content. There's no fluff in it, and everything you need to know about multifamily real estate. You can get it at my website, rodkhleif.com, or you can get it by texting ROD, R-O-D, to 41411. I also want to mention to you that we have some partnership opportunities coming up. We're actively buying small apartment buildings and mobile home parks, and I'm always looking for people to partner with me. So if you have an interest in potentially partnering together on a deal with me, shoot me an email to partner@lifetimecashflowacademy.com. That's partner@lifetimecashflowacademy.com. And, we've got a lot of activity happening. So if you have an interest in potentially partnering with me on some deals and looking over my shoulder as we do them together, send me an email. Now, it's an autoresponder email, so almost immediately you'll get an email back from us that has a link to our calendar. This is a link to set up a call with us to discuss partnering on our deals. Now, either myself or my partner Robert will get on the phone with you and get into some more detail about these opportunities that are coming up. That email again is partner@lifetimecashflowacademy.com. I know that's a lot. Anyway, I don't know if you've heard, we've had over 1 million downloads on this podcast, and I am so incredibly grateful to you guys for your amazing support. And during the last, it hasn't even been a year yet, but during the last, say, 11 months, I've spoken with or communicated literally about 1,000 of you. And I can honestly say it's been an incredible joy. I've really enjoyed connecting with you guys. And so many of you that I spoke with asked me for coaching, or they were to mentor, or asked me to create a course or some training materials. And I'd really never planned to do that. But when so many of you asked, I finally decided to go ahead and do it. And I hope you realize, especially if you've read my book, that I don't do anything halfway. I really try to add absolutely as much value as I can. So I'm excited to say, just within a couple of weeks, I'm going to be launching what I can humbly say is the best multifamily training and coaching program available anywhere. I've designed it to help you quickly crush it in multifamily real estate investing, help you build your own lifetime cash flow as fast as possible. Now, if you want to get some more information on that when it comes available, just text the word CRUSH, C-R-U-S-H, to 41411, and we'll make sure and send you the info when it comes up. And last, I want to ask you a favor, you guys a favor. If any of you listening have purchased a multifamily property as a result of the things you've heard or been inspired by in this podcast, please email me at rod@rodkhleif.com. That's R-O-D at RODKHLEIF as in Frank.com. And tell me about the property that you bought. I can't tell you how much pleasure I get when I get those emails and have conversations with you guys about your deals. So please give me that gift, when you take action and buy a property. Again, that's rod@rodkhleif.com. All right, let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow. I'm Rod Khleif, and I'm thrilled you're here. And I know you're going to enjoy the gentleman we're interviewing today. Now, this is something we haven't done yet. Shame on me. I should have done this a long time ago. But his name is James Eng, and he's a mortgage broker and with senior director for Old Capital in Dallas, Texas. And it's long overdue for me to have a mortgage broker on the show. So we're really going to get in, and I know we're going to add a ton of value to you guys today. James, thanks for being on the show.
Hey, thanks, Rod.
Absolutely. So I know that you have done a ton of business. You've financed over $75 million in multifamily properties, and you're also an investor in Texas. You're involved in 2,500 plus units. So I really think that we're going to talk about how you can help people finance their deals, and we're going to drill down on that if that's okay with you.
No, that's great. I mean, I think you're doing a great job on the podcast and educating investors. So let's just jump into it.
Awesome. So let me ask you a couple of questions before we dig in. So you've been a passive investor in Texas for how long? How long have you been in the business?
It's been about 2.5 years as a passive investor. So I started, my career really at GE Capital, and spent 10 years there going through their corporate finance leadership program. And then I was a loan underwriter for about 8 years there, and then moved over to Old Capital and really started looking at multifamily investing. And the best way for me right now has been passive. So I found general partners and invested into their deals, and now I'm in 2,500 units across, mostly in Dallas and one in San Antonio.
Fantastic. Fantastic. Okay. So let's talk about Freddie and Fannie. Okay. Because anybody doing larger deals, that's the financing that they're going to seek out first. So let's talk about the differences between the two and where you recommend one over the other.
Okay. So Fannie Mae really is, they'll do over $50 billion in loans this year on multifamily products. And Fannie Mae, we will go to them when number one, the property has to qualify. So the property needs to be 90% occupied for the last 90 days. And then the loan amount typically needs to be over $1 million. Right. So those two criteria in terms of the property have to qualify, but then also the borrower needs to qualify. So the borrower needs at least a year of multifamily experience for Fannie Mae. And then the size of the property also needs to be comparable to what they own now.
Okay.
So Fannie Mae does not want you to they don't want to be your first go around on a multifamily deal. Typically is not with Fannie Mae.
Okay. So for a new investor, they'd need to bring in a sponsor that has a similar type property, give up a piece, and then they might be able to approach Fannie Mae. How is Freddie Mac different?
Freddie Mac has a program, so they have a Freddie Mac small balance program that is $6 million and under. And that program, you can be a first-time investor, but the property needs to qualify again at 90% occupied for the last 90 days. But the unique thing, I think, on that one is that you cannot roll the rehab into the loan. So on Fannie Mae, you can do the total cost up to 80% of the total cost. Whereas Freddie Mac, they're going to constrict you to 80% of the purchase price.
Okay. With Fannie Mae, you can roll in the rehab and it'll bounce your loan amount up by proportionately, which is a fantastic benefit. So with Freddie Mac, what's the lowest they'll go? You told me the maximum, but
1 million.
1 million.
1 million.
Okay, so, all right.
1 million on Freddie Mac. Yep.
Okay. Are there particular types or classes of properties that they won't do?
They really, the big thing for them is affordable housing and workforce housing, which is where most investors are looking. So they're really in the B and C product type. Okay. In terms of class. So the stuff built, here in Texas, really 60s, 70s, and 80s is okay. Where we do a lot of business, because it seems like those are the properties that investors are looking for in terms of return. And then also Fannie and Freddie are very comfortable in those areas. What the properties they won't do are, really in the rougher demographic, rougher neighborhoods where there's been crime on the property. So a big red flag is, if there's been a murder or some sort of serious crime on the property in the last year, it is very difficult, it's not impossible, to get Fannie, Freddie financing on those properties.
Interesting. So you might have just as a what if you've got a property that hasn't had a serious crime, but it is in a tougher area? Is that just a question mark? Is it just going to be subjective based on who's looking at the deal? Right.
So they'll run crime reports on that property. Okay. They'll talk to the city. They'll figure out if that location they're comfortable with, and that's something that we can vet, sort of early in the process to see if they have a problem with it.
Okay. So let's say I'm a new investor and I want to establish a relationship with a good broker like yourself. What sorts of questions should someone ask you to determine if it's a good fit and to develop a relationship?
I think the first thing is really figuring out if they're going to be an independent owner or if they're going to be a syndicator, okay. Right? Because an independent owner is going to have to qualify for the loan on their own net worth and liquidity.
Right.
So Fannie Mae and Freddie Mac are going to want, the net worth of the individual to be equal to or greater than the loan amount. And then they're also going to want liquidity of 10% of the loan amount after the down payment. Okay. Right. So usually the first thing we ask people to send us is their personal financial statement. So once we get their personal financial statement, we can really give them an idea of what size loan they can qualify on their own. And if that property is large enough, let's say your net worth is $5 million and you have 500,000 in liquidity, and that's enough for you to go buy 100 units on your own, then that's the path we're going to take you down. But if you're going to syndicate it, then you're going to have to look at, not only that one investor, but then what other key principles are they going to bring on their team to qualify for the loan?
Okay. So it's not a bad idea, correct me if I'm wrong, for an investor to approach someone like you and go through that pre-qualification process to see what might be the best direction. And so you can let them know if they need to bring other people in on their team to pass muster with the lenders.
That's right. I mean, it makes it a lot easier if you know what you're qualified for, so that when you go and talk with listing brokers and other sellers on properties, that you're qualified to get the loan if you get the property under contract. Okay.
So back to my question, if someone is seeking a broker like yourself, are there any questions they should ask that broker to determine their level of experience? Or I suppose it's probably common sense. Maybe you just ask how much volume they've closed. And are brokers typically locked into particular market areas, or do you do loans all over the country? Just help me out on if someone is looking to start a relationship with a broker.
I think the questions you should ask is, number one, how much in volume they've done is a good first question. But then also, is that person financing properties that you want to finance, right? So if you go to a loan broker and they've done $1 billion this year, and that's been, $200 million deals and $100 million deals, that's probably not the right guy for you, because he's not going to spend the time to work with somebody buying $1 million property. So that's number one, is sort of average deal size and what types of properties they finance.
Okay.
And are they a specialist in multifamily? So we do probably 1 out of every 3 B and C apartments here in Dallas. So, multifamily is our specialty, and that's what we focus on. So any new Fannie, Freddie product out there, we know about. And so you have to, keep on top of that. And then the next thing besides loan volume and size of deal would also be talk to past clients. So I always get referrals from past clients and testimonials from them, and they're more than welcome to talk to any future clients. So
that's great advice.
Yeah. So if you want to talk to any of the individuals that I've worked with in the past, 6 months to a year on any of these deals, I can, give you their name and number and reach out to them. So I think that's the proof in the pudding is,
right.
Do they still want to work with you? I mean, that's the question I would ask any of these clients is, after working with this guy and closing the loan, would you work with him on the next transaction?
Fantastic. No, that's great advice. So let's say somebody's out there and they find a 32 unit and they happen to get it in the $1 million to $2 million range. What typical costs can they expect on the loan side? I mean, not the property cost so much, but maybe go through all the typical costs that they can expect to pay up front that need to factor into how they structure the deal, and whether or not they're going to take an acquisition fee and offset some of those costs. Well, actually, the cost would be billed right back in, but just for their time and whatnot. But go through the costs for us. Break down what's typical on a larger. Well, that's a smaller deal for you, but for some of the investors on my show, that'd be a very large deal. But in the $1 million to $2 million range.
Sure. Usually, we like to use about 3 to 4% in closing costs.
Okay.
On the loan amount. So that's gonna be typically that's a 1% origination fee on the loan. That'll be third-party fees such as engineering report, environmental, phase 1, appraisal. That's usually about $10,000. And then you're going to have 1% usually is for title and legal.
Okay.
So it adds up to about 3% of the loan amount on closing costs. And that's pretty consistent. I mean, as you move up the scale, it'll slide down to about 2%.
Sure.
And if it's under $1 million, it'll be closer to 4%. But 3% is a good number for closing costs. So, you can take your purchase price plus your rehab, and then, times 0.03 would give you a good number for closing costs.
Okay, fantastic. And for those of you that don't know it, an environmental phase one is a report that you have to do on any property that you're going to finance to make sure there's no toxic waste and whatnot. And if they find something, then they've got to do a phase two to make sure that, because what's scary about those is whoever owns that property is responsible. And so you always, even if you're buying a property cash, you should always, in my opinion, do a phase one and make sure that there's nothing toxic there. There wasn't a dry cleaner or something. But okay, so those are the costs. So talk about the sequence. Let's say, I mean, we talked about getting pre-qualified ahead of time. So they should seek you out and get an idea of what they can qualify for, can't qualify for, and put a team together. But let's say we're out there looking at properties. At what point should they engage you? And then what's the typical sequence for you facilitating the financing for an investor?
So usually when an investor decides that they're going to make an offer on a property, they will reach out to us and send us the current rent roll, the trailing 12 financial, and then their personal financial statement and resume. And then we will go out and source a loan for that particular deal and provide them a term sheet that they can provide with their offer. And then if the offer is accepted, then it usually takes anywhere from 45 to 60 days to complete the loan and get it approved and closed. And within those 45 to 60 days, that is where you're working intimately with the lender and myself to get all the due diligence in terms of appraisal, engineering, environmental report, and then also all the borrower due diligence. So Fannie Mae and Freddie Mac are going to have paperwork in terms of your balance sheet, your net worth and liquidity, bank statements, tax returns. They're going to ask for those things throughout that process to underwrite you as the property owner, but then also underwrite the property financials, and they're going to do an inspection on the property over that time frame, and then they'll submit it for approval. And then once it's approved, it usually takes about a week from there to close the loan. Okay. So we usually like to tell people, if you're submitting an LOI or a letter of intent right now, usually about 60 days from beginning to end is enough time to get a Fannie or Freddie loan done. Okay,
fantastic. Okay. Now, when you are dealing with investors, what makes your life easier?
If an investor comes to us and tells us, look, I have my whole team ready to go, and I have, this is the pro forma for the property. These are the historical financials. This is what we're going to do in terms of the rehab, and then, execute that plan. That makes my life a lot easier, right? So somebody coming in, they've educated themselves on the market, they've educated themselves on the property, and they need assistance finding the loan. But outside of that, they have their whole team ready to go. So that makes the process a lot smoother, and it helps getting the loan approved, because when the underwriter for that loan asks for specific things, whether it's borrower entity docs or the rehab budget or the pro forma for the rent, we have all that information ready to go. So in this business, it's people who understand numbers and people who are organized that can get deals done quickly, and that will translate into more and more deals for you if you're able to perform on your LOIs that you present.
Sure, absolutely, and it either builds or destroys your reputation. So what words of wisdom would you share with an aspiring commercial real estate investor? Let's say somebody wants to syndicate, they're motivated, they want to get something done. Any advice that you would give them?
I think the first thing is constant learning. Listening to podcasts like this definitely is, step one in terms of education. And that gives you sort of a base foundation. The second piece of advice would definitely be to find a mentor in the space, someone that has done deals before, has, invested in the area that you're investing in or the type of property that you're investing in, because B and C multifamily is very different than Class A multifamily. Sure. So understanding the B and C space, and then also really gathering, your team is probably my third thing, is start figuring out who's a mortgage broker that you can trust, figure out a property manager that you can trust, start building relationships with listing brokers. And, the fourth thing is really just, you have to be proactive and take action in this business. As a mortgage broker, I don't get paid until a deal closes. And the same way, real estate investors don't make money until deals close and they make it to the finish line. So being very proactive and pushing until you hit closing.
Yeah, no, that's great advice. And I should have asked this question before that, but let me ask it now. What do you think? What's the most challenging part of what you do as it relates to investors?
The most challenging part is really when something comes up in the due diligence and the borrower has to make a decision on whether or not they're going to move forward with the deal, and what changes they have to make either to the org structure or raising more equity. That becomes the most challenging. So most of these deals are pretty stabilized and there's not a lot of moving pieces, but if something comes up in a deal that we didn't know about during due diligence, that's when it becomes most challenging. So the borrowers who have not only plan A, but plan B and plan C ready to go in case it doesn't work out is the guys who do the best in this business sometimes, because they're able to adjust. I mean, a good example is, when Trump was elected at the end of last year, interest rates went up 50 to 60 basis points.
Right.
And if you were not prepared with more equity into these transactions, you were left, not being able to close loans, not being able to close deals. So the guys who were able to step up and raise the additional equity to get deals closed in the fourth quarter, those brokers remember those borrowers.
Well, let me ask you a question so my listeners understand. Why did the rate increase cause equity requirements to go up?
So for Fannie Mae, their rate is tied to the 10-year Treasury. So 10-year Treasury was closer to 1.8%, and now it's closer to 2.4 today. And when that goes up, the debt service on these properties, the debt service on these loans goes down. And so the minimum debt service on a lot of these deals on acquisition is 125. So, 125,000.
You're talking about the debt service coverage ratio. Would you tell my listeners what that calculation is, just so they understand?
Sure. Yeah. So it's your net operating income over the debt service. So let's say your net operating income was 125,000 and your debt service was 100,000. Then you would have a 125 debt service coverage.
So that's the minimum that they'll take, right?
That's the minimum that's determining your loan size.
Okay.
And so if the debt service goes up to, let's say, 110,000 all of a sudden, the property is still the same property and it's still throwing off 125,000. But now that the debt service went up because of the larger increase in interest rate, the loan cannot be the same size that you thought it was, in September or October before Trump was elected.
So the loan has to be reduced to get that debt service coverage ratio back to 125. Got it. Now give an example of how something you might discover in due diligence could impact the loan amount and why you should have a plan B.
I mean, sometimes during due diligence, we'll order an appraisal and it'll come up short.
Okay.
So I mean, just because you're buying it for a certain amount, sometimes the appraisal will come in short, and the loan is typically, the max loan is usually 80% of that appraised value. So if it comes up short, and then another thing that can come up is really during the engineering report. So if the engineer goes out there for the lender and they say maybe it's electrical issue or a parking lot or a roof that needs to be replaced, something that you didn't catch in your initial underwriting, that could, there could be a holdback of the loan of 100 or 200,000 for a new roof. And so that changes your metrics, and that changes, how much you're having to invest in the property day one.
Or how much equity you have to raise, and, if you haven't planned for something like that. Great.
Right.
Any books or training that you might recommend to an aspiring commercial real estate investor? Are there any books that you like to gift?
Obviously Rod has a book, so
No,
that's a great place to start.
I totally was not plugging for my book at all.
I think everyone obviously should read, just your standard, Rich Dad Poor Dad book.
Sure.
I think to start off, but then also, I like the mindset of, I think it was the Keller Williams group who came out with the One Thing.
One Thing, yeah, that's an awesome book.
One Thing, because where it started for me really was, if my focus when I left GE Capital and came to Old Capital really was on how do I become a better investor, and how do I create passive income through real estate. And so if that's your first thing and that's what you focus on, then I think you'll become better and better at it, and the decisions you make will stream out of that.
Love it. No, that's great advice. And thank you for plugging my book. And that totally wasn't where I was going with that. But since you mentioned it, it's still free, guys. So if you want it, text Rod to 41411. It's 200 pages about multifamily investing. And I've gotten great reviews on it. And so it's still free. I'm still waiting for a few testimonials before I print it and put it on Amazon. So get it if you want it. Listen, James, you've added a ton of value, buddy. I really appreciate you taking your valuable time to be on the show. And, I'm going to have his contact information in the show notes, guys. So if you have questions about financing or want to develop a relationship, James Eng at Old Capital. So you'll be able to access him, like I say, in the show notes. Thanks, James.
Thanks a lot, Rod.
Absolutely.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please subscribe and then take a moment to visit iTunes and leave a 5-star rating and review. For more resources to connect with us further, please visit our website at lifetimecashflowpodcast.com. Tune in next week for our next show.